Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today, we're going to go through a short attack case study, and we're going to go through eHealthinsurance, which is a structural short attack that I launched in 2014 and 2015. There were four reasons that made this company attractive as a short. The first was there was a lot of investor hype around exchanges and the company's product because of the coming launch of Healthcare.gov. Secondly, there were some concerns because no one really understood the true churn of the individual family plan business. There were some technology issues and possible misrepresentations around how it related to healthcare.gov and other things the company could do. And then finally, when I covered the company in 2011, I felt at an investor conference they had made a misrepresentation that caused me to put the company in my skeptical list. So what triggered the short attack? I launched with a negative hold in June of 2014. And in July of 2014, they reported second quarter earnings that drove the stock from 38 to 22. And in talking to management and listening to the call, it was clear to me that there were a lot of misrepresentations from investors and management about how the stock and business was going to perform over the next 6 months. So what were the irrefutable premises that drove this short attack? The first was investors were calling it the Amazon.com of healthcare. This was never going to be true. The second key debate was around their technological and business relationship to healthcare.gov. Investors were viewing this as a positive catalyst for the business, when I was viewing it as a negative catalyst because I felt they were misrepresenting the technological connections between eHealth and healthcare.gov. Ultimately, healthcare.gov's launch was a negative catalyst for the company because it led to the third irrefutable premise, which was that the IFP member churn was significantly higher than anyone anticipated. And so that ultimately led the stock to go from 22 to 28 and then down to 9 when they missed fourth quarter numbers. The way management resolved the situation was that they changed management and changed strategy away from IFP towards Medicare, Medicaid. And that made the stock go from 7 to 150. So management gets a lot of credit for being professional throughout the short attack and not making personal attacks and letting the thesis play out. And again, for management teams, it's hard to live through a short attack, but you have to know that for the company, there's a lot of light at the end of the tunnel if you do make the necessary changes to refute that attack. Thanks for watching. Always here to help you with your capital markets, investor relations, and corporate finance needs.